You're standing in line at the grocery store in March 2022, watching the cashier ring up your usual weekly items: eggs, milk, bread, chicken. The total flashes on the screen, and you feel your stomach drop. $47. Last year, this same cart cost $31. You look at the receipt, searching for the mistake, but there isn't one. Food prices just exploded by 50% in 12 months, and nobody seems able to explain why it happened so suddenly or when it will stop. But here's what the grocery chains and economists and government officials won't tell you clearly. This isn't new, this isn't random, and this definitely isn't a one-time shock caused solely by COVID or the war in Ukraine. What you experienced in 2022 was the fourth time in 50 years that food prices have surged dramatically, seemingly out of nowhere, devastating household budgets and pushing millions worldwide into hunger. The pattern repeats with mechanical precision every 8 to 10 years. Prices explode, governments scramble, people riot in some countries. Then, just as mysteriously as they spiked, prices calm down and everyone forgets until the next cycle begins. The United States Department of Agriculture has documented this phenomenon extensively. Research published by their Economic Research Service confirms that major food price spikes have historically occurred 6 to 8 years apart. Not randomly, not unpredictably, the cycle exists. The question is, why does it repeat so consistently? And more importantly for you standing in that grocery line in 2025, when will it happen again? Let me show you the pattern first, then we'll dissect the machinery that drives it. In 1973 and 1974, global food prices more than doubled. Wheat, corn, soybeans, rice, everything shot upward simultaneously. Families that had spent 10% of their income on food suddenly spent 18%. Food riots erupted across developing nations. The crisis lasted roughly 2 years before prices stabilized at a higher baseline than before. Then came 1995 and 1996. Grain prices surged dramatically. Corn prices increased over 100%. Wheat reached levels not seen since the 1970s crisis. The spike was shorter this time, lasting about 18 months. But the impact on food budgets was severe. Prices eventually declined but settled higher than pre-crisis levels. Fast forward to 2007 and 2008. This was the big one that modern memory holds most clearly. From January 2004 to May 2008, rice prices increased 224%. Wheat jumped 108%. Corn climbed 89%. The International Monetary Fund's Food Price Index rose 130% from January 2002 to June 2008. Riots broke out in Haiti, Bangladesh, Mozambique, Egypt. Governments fell. 37 countries faced food crises simultaneously. Then, over 6 months in late 2008, prices crashed by a third as the global financial crisis destroyed demand. But the cycle wasn't finished. Prices started climbing again in 2009. By June 2010, they accelerated sharply. January 2011 saw the food price index exceed even the 2008 peak. This spike was driven primarily by a devastating drought in Russia that reduced their wheat harvest from 97 million tons in 2009 to just 60 million tons in 2010. Russia banned wheat exports in August 2010. Global prices surged nearly 25% by January 2011. Egypt, heavily dependent on Russian wheat, saw import costs jump from $183 per ton to $280. The resulting food price pressures contributed significantly to the political instability that sparked the Arab Spring protests across the Middle East and North Africa. Now we arrive at 2022. The pattern repeated once more. Global food prices hit an all-time high in March 2022, according to the UN Food and Agriculture Organization. The index averaged 159.3 points that month, up nearly 13% from February alone. Vegetable oil prices reached 248.6 points. Cereal prices hit 170.1 points. Both were record levels in the history of the index dating back to 1990. What started as COVID-related supply chain disruptions in 2020 and 2021 accelerated dramatically when Russia invaded Ukraine in February 2022. Together, Russia and Ukraine produce about 30% of global wheat and barley exports. Ukraine alone exported nearly $12 billion worth of cereals in 2021. When Russian forces blockaded Ukrainian Black Sea ports, global wheat exports from Ukraine dropped over 90% in the immediate aftermath. 5 major crises in 50 years, roughly 8 to 10 years apart. But this raises the critical question: what actually causes these synchronized global food price explosions? Why do they happen with such regularity? And why do prices eventually calm down? The answer lies in understanding that food markets operate on cycles driven by inventory levels, weather patterns, energy costs, and policy responses that interact in predictable ways. Think of the global food system as a bathtub with water constantly flowing in from farmers planting crops and flowing out as people consume food. The water level in the tub represents grain stockpiles held in warehouses around the world. When stockpiles are high, the system can absorb shocks. A drought in one region gets compensated by reserves elsewhere. Prices stay stable, but when stockpiles drop to critically low levels, even a small disruption causes prices to spike violently because there's no buffer left. Historical data from the Food and Agriculture Organization reveals a clear pattern. Every major price spike since 1960 has coincided with periods when global grain stocks relative to usage fell to critically low levels. In the early 1970s, global grain stocks plummeted. By 1973 and 1974, wheat stocks in Australia had fallen 93% from 1970 and 1971 levels. Canada's wheat reserves dropped 64%. United States wheat stocks declined 59%. The buffer was gone. When production fell due to poor harvests, prices exploded because there were no reserves to draw from. The same pattern preceded 2007 and 2008. In February 2008, United States wheat stockpiles hit a 60-year low. Global stocks-to-use ratios for cereals reached their lowest level since the 1970s crisis. The system was vulnerable. Then came a series of weather shocks. Drought devastated Australia's wheat crop, one of the world's largest exporters. The 2006 harvest produced only 9.8 million tonnes compared to normal years of 25 million tonnes. Unseasonable heat waves and droughts hit other major producing regions. With stocks already depleted, these production shortfalls sent prices skyrocketing. The 2010 and 2011 spike followed the identical script. Russia experienced what meteorologists called a flash drought in summer 2010, the worst in 130 years. Temperatures peaked at record levels. Wildfires consumed cropland. The drought began in June, then intensified rapidly through July just as wheat crops reached their most vulnerable flowering stage. Wheat yields in Russia's top producing regions fell over 70%. Total wheat production dropped 20 million metric tons compared to previous seasons. Russia's government banned wheat exports in August 2010 to preserve domestic supplies. Global wheat stocks, already relatively low, took another hit. Prices surged. Each crisis starts the same way. Stockpiles drift lower over several years as farmers and governments reduce expensive inventory holdings. Then a trigger event hits. Weather destroys crops in a major producing region, or energy prices spike, making fertilizer and transportation more expensive, or a geopolitical event disrupts trade flows. With stocks depleted, the system has no shock absorber, prices explode upward, but weather and low inventories alone don't fully explain the synchronized timing of these crises every 8 to 10 years. There are deeper structural forces at work. One critical factor is the relationship between food prices and energy costs. Crude oil and natural gas are fundamental inputs for modern agriculture. Fertilizers are manufactured using natural gas. Tractors, combines, and irrigation pumps run on diesel. Food gets transported thousands of miles using trucks, trains, ships, all powered by petroleum. When energy prices spike, food production costs surge, and those costs flow directly into food prices. Look at the timeline. The 1973 and 1974 food crisis coincided exactly with the first OPEC oil embargo. Oil prices quadrupled from roughly $3 per barrel to $12 by early 1974. The energy shock drove up fertilizer costs and transportation expenses, just as grain stocks were depleting. The combination was devastating. The 2007 and 2008 food crisis occurred as oil prices climbed from $60 per barrel in 2007 to $147 in July 2008. Energy costs drove fertilizer prices up over 200%. Farmers faced higher input costs. Food processors paid more for energy, transportation became more expensive. All of it flowed through to consumer prices. The 2022 crisis saw the same pattern. Oil prices, which had crashed below $20 per barrel during COVID lockdowns in 2020, recovered to over $120 by June 2022, following the Ukraine invasion. Natural gas prices more than doubled. Fertilizer costs skyrocketed. The Food and Agriculture Organization reported that fertilizer prices increased alongside crude oil and natural gas, creating compounding pressure on food production costs. Energy and food are linked in ways most people don't see until crisis hits. When you fill your gas tank and it costs $90 instead of $40, that same price pressure is simultaneously hitting the farmer who needs diesel to plant wheat, the fertilizer manufacturer who needs natural gas to produce ammonia, the trucking company that delivers grain to processors, and the bakery that needs energy to run ovens. All of it compounds into the price of bread you buy at the grocery store. But there's another force that amplifies these cycles. Policy responses by governments that seem logical in isolation, but create cascading effects globally. When food prices start rising in a country, governments face enormous political pressure to prevent domestic prices from increasing. The typical response is export restrictions. A country producing wheat decides to ban or tax wheat exports to keep more supply at home and protect consumers. This seems reasonable from that government's perspective. But when multiple exporting countries impose restrictions simultaneously, global supplies available for trade shrink dramatically, and prices spike even higher in countries that depend on imports. Research published after the 2007 and 2008 crisis found that 3/4 of the rice price increase in 2008 occurred specifically because major exporters imposed export bans. India banned rice exports in October 2007. Vietnam restricted exports. Thailand considered similar measures. Importing countries panicked. The Philippines, heavily dependent on rice imports, began buying aggressively to secure supply before markets tightened further. This panic buying drove prices higher, which triggered more export restrictions, which caused more panic buying, a vicious cycle that turned a supply shortage into a price explosion. The same dynamic played out in 2010 and 2011. When Russia banned wheat exports in August 2010, other countries followed. Ukraine, Kazakhstan, and several other grain producers imposed restrictions. Importing nations, particularly in the Middle East and North Africa, scrambled to secure alternative supplies. Egypt, which imported half its wheat from Russia, suddenly faced a crisis. The government had to purchase from France and the United States at prices 50% higher than they had paid Russia. The export bans reduced global tradable wheat by substantial percentages just when stocks were already low. Prices rocketed upward. During 2022, the pattern repeated yet again. As the Ukraine war disrupted grain flows, various countries imposed export restrictions to protect domestic supplies. India banned wheat exports. Several Southeast Asian nations restricted rice. Each restriction removed supply from global markets and pushed prices higher for importing countries. The World Trade Organization estimated that without these restrictions during the 2010 and 2011 crisis, prices would have been 13% lower. The restrictions that governments implement to protect their citizens end up intensifying the global crisis. Then there's the role of financial speculation. When commodity prices start rising, investment funds notice. They buy futures contracts, betting prices will continue climbing. This additional demand for commodity futures can push prices even higher, which attracts more speculators, creating a feedback loop. Research analyzing the 2007 and 2008 crisis found evidence that excessive speculative activity amplified food price spikes even after accounting for supply and demand fundamentals. The financialization of commodity markets, where investors treat agricultural products like stocks or bonds, added a new layer of volatility to a system that was already under stress. Studies published in agricultural economics journals examined the impact of index funds and institutional investors entering commodity markets. These large investors don't actually want to buy physical wheat or corn, they're seeking portfolio diversification or betting on price trends. But their trading activity affects futures prices, which in turn influences how much farmers decide to plant and how much grain processors decide to buy. When speculation drove wheat futures to extreme levels in 2008, Some evidence suggests it created prices disconnected from actual supply and demand, at least temporarily, making the spike worse than fundamentals alone would have justified. Now let's examine why prices eventually calm down after these explosions. The mechanism is actually straightforward economics, but it takes time to work through the system. High prices create powerful incentives. Farmers see wheat selling for $8 per bushel instead of $4, and they respond by planting more wheat. Land that was used for other crops or left idle gets converted to wheat production. Farmers invest in more fertilizer and better seeds to maximize yields. This supply response doesn't happen overnight because farmers can only plant during specific seasons. But within 1 or 2 growing cycles, production increases substantially. Historical data shows this pattern clearly after every crisis. Following the 1973 and 1974 price spike, harvested areas of wheat, corn, and soybeans in the United States expanded over 20% from 1974 to 1980. Farmers brought land from government conservation programs back into production. Multinational agricultural companies invested billions in developing infrastructure in Brazil and Argentina, turning those countries into major grain exporters. The production surge, combined with slower demand growth as high prices destroyed consumption, caused global stocks to rebuild. Prices eventually declined. After the 2007 and 2008 crisis, the same dynamic played out. High crop prices in 2008 stimulated record investment in agriculture globally. Russia, China, India saw massive increases in farmland and agricultural infrastructure. By 2010, global grain production had expanded significantly. Stocks began rebuilding. Prices fell from their 2008 peaks and remained lower for several years until the next supply shock hit in 2010 with the Russian drought. The demand side also adjusts. When wheat prices double, consumers and food processors change behavior. Households shift from expensive proteins like beef toward cheaper alternatives. Food manufacturers reformulate products to use less expensive ingredients. Countries that import wheat at $280 per ton reduce purchases and draw down domestic stocks to stretch supplies. Feedlots reduce the amount of grain fed to livestock. All of this demand destruction, combined with the supply increase from farmers planting more acres, brings markets back toward balance. But here's the critical insight about why this cycle repeats rather than permanently resolving. The structural vulnerabilities remain. After each crisis subsides and prices fall back down, the pressures that reduce stockpiles gradually rebuild. Maintaining large grain reserves is expensive. Governments that stockpiled grain during the crisis face budget pressures to reduce spending. Private companies that built inventory pay storage costs and see capital tied up in grain sitting in silos. As years pass without another shock, the perceived need for large buffers diminishes. Stocks drift lower again. Energy markets remain volatile, so oil prices can spike suddenly. Weather patterns driven by complex climate systems continue producing droughts and floods. The geopolitical landscape stays unpredictable. Think of it like earthquake preparedness. After a major earthquake, building codes get strengthened, emergency supplies get stockpiled, and everyone takes preparedness seriously. But as decades pass without another big quake, standards gradually erode. Emergency kits expire and don't get replaced. Building code enforcement gets lax. Then the next earthquake hits and everyone asks how we weren't prepared despite knowing the risk. Food markets work similarly. After each crisis, there's brief focus on building stocks and investing in agricultural infrastructure. Then, as normalcy returns, the discipline fades, stocks decline, investment slows. The system becomes vulnerable again. Climate change is adding a new dimension to this cycle that researchers are still working to fully understand. Weather extremes appear to be intensifying. The Russian drought of 2010 was described as the worst in 130 years. Australia's drought from 2006 to 2009 reduced their rice harvest by 98% and wheat production dramatically. These aren't normal weather variations. They're extreme events that climate scientists suggest may be becoming more frequent. If droughts and floods hit major agricultural regions more often, the frequency of supply shocks could increase. That would mean shorter intervals between crises and potentially more severe price spikes. Research published by the International Food Policy Research Institute examining drivers of price volatility found that weather-related production shortfalls have been significant contributors to every major spike. The 1973 crisis involved poor harvest globally. The 1995 and 1996 spike was triggered by drought in the United States Midwest. The 2007 and 2008 crisis saw multiple weather events, including Australia's drought. The 2010 and 2011 spike stemmed from Russia's devastating drought. The 2022 situation, while primarily driven by the Ukraine war, also occurred against a backdrop of drought in several regions. If climate change makes extreme weather more common, the 8 to 10 year cycle could compress. We might see major food price shocks every 5 or 6 years instead, or multiple smaller shocks that keep prices elevated more consistently rather than spiking and crashing. Climate modelling studies suggest increased volatility in agricultural production is likely, which translates directly to increased food price volatility. The human cost of these cycles is staggering and often invisible to people in wealthy countries. When food prices spiked in 2007 and 2008, an estimated 130 to 155 million additional people were pushed into poverty globally. The 2010 and 2011 crisis reportedly increased the number of poor by another 44 million. The 2022 spike, according to the UN Food Security Information Network, contributed to 258 million people facing acute food insecurity, the highest number in the history of their reporting. These aren't just statistics, they're families that cut from 3 meals to 2. Children who suffer malnutrition that affects their development permanently. Small farmers who can't afford fertilizer at inflated prices and see their yields collapse. Urban workers whose wages don't keep pace with food inflation and who must choose between eating and paying rent. In countries where households spend 50 to 70% of income on food, a doubling of prices is catastrophic in ways Americans spending 10% of income can barely comprehend. The riots that erupt during food crises aren't simply about hunger. They're expressions of rage at a system that seems designed to benefit the few while devastating the many. When bread prices triple in Egypt and people can't feed their children, while grain traders and speculators profit from price volatility, social contracts break down, governments fall, migrations accelerate, political extremism finds fertile ground. Now let's talk about where we stand today in December 2025. The 2022 food price spike has largely subsided. The Food and Agriculture Organization's price index fell from its March 2022 peak of 159.3 points to around 120 to 130 range by late 2023 and 2024. Prices remain elevated compared to pre-COVID levels, but are down significantly from the crisis peak. Does this mean we're safe? Does this mean the next cycle is years away? Not necessarily. Let's examine the inventory situation. Global grain stocks have been rebuilding but remain relatively tight by historical standards. The stocks-to-use ratio for cereals, which measures how many days of consumption are held in reserve, improved from crisis lows but hasn't returned to the comfortable levels seen before 2007. The United States Department of Agriculture reports ending stocks for wheat and corn are adequate for current demand but leave limited room for major production shortfalls. Energy prices have moderated from their 2022 peaks, but remain volatile. Crude oil fluctuates between $70 and $90 per barrel, down from the $120 highs of mid-2022 but still elevated. Natural gas prices have cooled significantly in many markets, relieving some pressure on fertilizer costs. But geopolitical risks remain. Conflicts in the Middle East could disrupt oil supplies. Economic sanctions affect energy trade flows. A cold winter in Europe could spike natural gas demand. The energy-food price link remains active and dangerous. Climate patterns show concerning signs. Parts of the United States experienced significant drought in 2024. South America faced weather disruptions affecting soybean and corn production. These haven't yet triggered a global crisis because overall production remained adequate, but the warnings are visible. El Niño and La Niña weather patterns continue their cycles, affecting rainfall and temperature across major agricultural regions. Climate scientists warn that the baseline climate has shifted, making extreme events more probable. The geopolitical landscape offers no comfort. The Ukraine war continues affecting grain exports, though established alternative shipping routes have partially compensated. Tensions between major powers create risks to trade flows. Political instability in several grain exporting regions could trigger supply disruptions. the interconnected global food system remains vulnerable to shocks that can cascade rapidly. If we follow the historical pattern, the next major food price crisis would be expected around 2030 to 2032, roughly 8 to 10 years after 2022. But that assumes the cycle continues at its historical pace. Climate change and geopolitical instability could accelerate it. Alternatively, if governments and agricultural systems learned from recent crises and built stronger buffers, the next shock could be delayed or dampened. The pattern suggests another explosion is coming. The timing and severity remain uncertain. What can individuals do with this knowledge? For people in wealthy countries where food represents a small share of income, the impacts are manageable but still significant. Understanding the cycle helps with planning. When food prices are relatively low, as they are in late 2025 compared to 2022 peaks, stocking up on non-perishables makes sense. When energy prices are moderate, food costs will likely stay contained. When drought hits major agricultural regions or energy prices spike, expect food costs to rise within months. The cycle gives you advance warning if you know how to read the signals. For policymakers, the implications are profound. The cycle repeats because structural vulnerabilities aren't addressed during calm periods. Building and maintaining strategic grain reserves is expensive, but it's insurance against catastrophic price spikes. Investing in agricultural research to develop drought-resistant crop varieties pays dividends when weather shocks hit. Creating better early warning systems for crop failures allows faster response before panic sets in. Establishing international coordination to discourage export bans during crises could prevent the policy-driven price amplification we've seen repeatedly. For the agricultural sector, understanding the cycle is about managing risk. Farmers know that planting more when prices are high can be lucrative, but they also know that oversupply eventually crashes prices. Grain companies that maintain larger inventories during low-price periods can sell profitably when the next spike hits. Food processors that lock in long-term contracts at favorable prices protect themselves from volatility. Investment in agricultural infrastructure and technology pays off over multiple cycles. The broader lesson is about complex systems and their rhythms. Food markets aren't chaotic, they're cyclical. The 8 to 10 year pattern exists because the time it takes for stocks to deplete, shocks to occur, prices to spike, supply to respond and equilibrium to return follows predictable timeframes. Weather patterns operate on cycles. Agricultural investment cycles take years from decision to production. Policy responses and their effects unfold over months and years, not days. These timeframes create the periodicity we observe. Some analysts worry that the historical cycle might be breaking down. Climate change could make weather shocks more frequent and severe, compressing the cycle. Geopolitical fragmentation could disrupt trade flows more persistently. Financial speculation in commodity markets might amplify volatility beyond historical norms. On the other hand, technological advances in agriculture, from precision farming to genetic improvements, could make production more resilient. Better weather forecasting could help farmers adapt. Improved logistics could reduce waste and smooth supply chains. The reality likely involves both forces, the underlying cycle driven by inventory dynamics, weather variability, energy costs and policy responses will probably continue. But its manifestation might change. We might see more. Frequent but smaller spikes rather than massive explosions every decade. Or we might see the opposite. Longer periods of stability punctuated by even more severe crises when climate shocks exceed anything in historical experience. The past provides patterns but not guarantees about the future. One aspect that deserves more attention is how price spikes affect different populations within countries. In the United States, households in the lowest income quintile spent over 32% of their after-tax income on food in 2023. For them, a 50% increase in food prices is devastating. Middle-income households spent around 13% on food, still significant but more manageable. Wealthy households spent just over 8%. A price spike that's catastrophic for poor families is merely inconvenient for the wealthy. The cycle hits hardest those least able to absorb the shock. This inequality dimension means food price volatility isn't just an economic issue, it's a social justice issue. Programs like food stamps and school lunch assistance provide crucial buffers during price spikes for vulnerable populations. Countries that maintain strong social safety nets can protect their poorest citizens from the worst impacts. Countries without such systems see immediate increases in malnutrition and hunger when prices surge. Globally, this disparity is even starker. Wealthy countries can subsidize food costs for their populations or import from alternative suppliers when prices rise. Poor countries lack those options. When global wheat prices double, wealthy countries pay more but everyone still eats. Poor countries face famine. The cycle that's an inconvenience in New York is a death sentence in some parts of sub-Saharan Africa or South Asia. This reality should haunt anyone studying these patterns. The 2022 food price spike demonstrated something important about how these cycles evolve in the modern era. Unlike previous crises that developed over months, the 2022 explosion happened within weeks of the Ukraine invasion. Markets are more globally integrated and react more quickly than in previous decades. Information flows instantly. Futures markets respond to news in minutes. This speed means future crises might spike faster and more violently than historical patterns suggest. The 8 to 10 year cycle between crises might remain, but the velocity of price changes during crises could accelerate. Looking specifically at different commodities reveals additional complexity. Wheat and corn prices tend to move together because they're substitutes in many uses, particularly animal feed. When wheat becomes expensive, livestock producers switch to corn, driving up corn prices. Rice operates somewhat independently because it's consumed primarily as human food rather than animal feed, and major rice-producing regions differ from wheat and corn zones. The 2007 and 2008 crisis saw rice prices spike separately from other grains, driven partly by export restrictions from Asian producers. Understanding these intercommodity relationships helps predict how shocks propagate through the food system. Livestock products like beef and pork follow related but distinct cycles. When grain prices spike, the cost of feeding cattle and pigs rises dramatically. Some farmers reduce herds, cutting future meat supply. Meat prices often rise with a lag after grain price spikes as producers pass through higher costs and as reduced herds tighten meat supplies. The cattle cycle in particular can take years to play out because it takes time to rebuild herds after they're reduced. The egg market provides a recent example of how disease shocks interact with the broader food price cycle. Highly pathogenic avian influenza outbreaks that began in 2022 decimated egg-laying flocks in the United States. Egg prices surged to record levels, increasing over 300% from 2021 to early 2023. While connected to the broader food price pressures of 2022, the egg crisis had its own specific driver, disease, that created a mini-cycle within the larger pattern. As flocks recovered through 2024 and into 2025, egg prices declined substantially but remained elevated compared to pre-outbreak levels. These commodity-specific cycles remind us that while the broad 8 to 10 year pattern exists for overall food prices, individual products follow additional rhythms driven by their unique supply chains, production cycles, and shock vulnerabilities. The wheat cycle, the cattle cycle, the egg cycle, they all overlap and interact to create the complex volatility we observe in food budgets. What about technological solutions that might break the cycle? Vertical farming, lab-grown meat, genetic engineering of drought-resistant crops. Do these innovations change the fundamental dynamics? The honest answer is that they help on the margins but haven't yet transformed the system. Vertical farming remains expensive and limited to high-value crops like lettuce. Lab-grown meat is still commercially nascent. Genetically modified crops have increased yields and pest resistance, which helps, but weather still affects production. Technology evolves slower than hype suggests. The next food price crisis will likely hit before technological silver bullets are deployed at the scale needed to fundamentally alter global food security. One area where technology has made clear impact is in weather forecasting and crop monitoring. Satellite imagery can detect drought stress in crops weeks before harvest, giving markets early warning. Climate models can predict El Niño events months in advance, allowing farmers and policymakers to prepare. Better logistics and supply chain management reduce waste and smooth distribution. These improvements don't prevent crises, but they can dampen them compared to what would have occurred with 1970s-era information and infrastructure. Financial innovations like weather derivatives and crop insurance have also evolved. Farmers in some regions can buy insurance that pays out if rainfall falls below certain levels or if regional yields drop significantly. This doesn't change the physical crop failure, but it protects farmers financially, helping them survive bad years without going bankrupt. In theory, better risk management should reduce the volatility of the cycle. In practice, many farmers worldwide lack access to these tools, so their impact remains limited. The interconnection between food, water, and energy creates what analysts call the resource nexus. You can't understand food price cycles without understanding energy cycles, and you can't understand either without understanding water availability. Agriculture consumes roughly 70% of global freshwater withdrawals. When drought reduces water availability, crop production falls. When energy costs spike, pumping water for irrigation becomes more expensive. These systems are linked physically and economically. Climate change stresses all three simultaneously, making water more scarce in many regions, affecting agricultural production, while the energy transition changes fuel costs. The food price cycle is embedded in this larger resource cycle that might be accelerating. Population growth adds another dimension. Global population continues rising, though growth rates have slowed from their 1970s peaks. More people means more food demand. The world population increased from roughly 4 billion in 1975 to over 8 billion today. That doubling of demand has been met through agricultural intensification, higher yields per acre rather than massive expansion of farmland, but intensification has limits. Soil degradation, water depletion, loss of genetic diversity in crop varieties. These are long-term pressures that make the system more fragile and potentially more vulnerable to shocks. Dietary changes complicate the picture further. As incomes rise in developing countries, people consume more meat and dairy. This requires more grain to produce. It takes about 7 pounds of grain to produce 1 pound of beef. China's rapid economic growth since 1990 dramatically increased its meat consumption, which increased its grain imports and affected global markets. This dietary transition is ongoing. India's middle class is expanding. African countries are developing economically. If several billion more people shift toward more meat-intensive diets over the coming decades, the pressure on grain supplies intensifies. This could amplify the food price cycle or make prices stay elevated more persistently. Trade policy represents another wild card. The globalized food system that emerged after World War II assumes open trade in agricultural products. Countries specialize in what they produce efficiently and import the rest. This system works well during stable times. During crises, it becomes fragile. When countries impose export restrictions to protect domestic supplies, the system fractures. Some analysts argue for more regional self-sufficiency in food to reduce vulnerability to global shocks. Others counter that self-sufficiency is inefficient and would raise costs while reducing resilience by concentrating risk. This debate will intensify as the next crisis approaches. The grain reserves issue deserves deeper examination because it's central to the cycle. After the 1970s crisis, many countries maintained strategic reserves. The United States held large stocks. China built enormous reserves, but maintaining reserves is expensive. Grain sitting in storage slowly deteriorates. It ties up capital. During the 1980s and 1990s, as prices stabilized, many governments reduced stockpiles to cut costs. They relied instead on global markets to provide buffer. This worked until everyone tried to draw from the global market simultaneously during crises, at which point prices exploded. China is an interesting case study. Unlike Western countries that reduced reserves, China has maintained and even expanded grain stockpiles since the 2000s. Some estimates suggest China holds roughly half of global wheat stocks, despite being about 18% of global population. This massive stockpiling insulates China from global price shocks, but reduces stocks available to global markets during crises, potentially making volatility worse for other countries. China's strategy, self-reliance through stockpiling, worked for them during recent crises but contributed to tighter global markets. The speculative dimension of food price spikes remains controversial. Some economists argue speculation merely reflects fundamentals and provides market liquidity. Others point to evidence that when large institutional investors enter commodity markets, primarily as financial assets rather than commercial hedges, their buying can drive prices above levels justified by physical supply and demand. The truth likely lies between these views. Speculation alone can't create sustained price increases without underlying supply constraints, but it can amplify and accelerate moves that would occur anyway. Looking at the current situation in late 2025, several signals deserve monitoring. First, watch grain inventory reports from the United States Department of Agriculture, When stocks-to-use ratios for major grains fall below 20%, the system becomes vulnerable. We're not there yet, but the trend matters more than the current level. Second, track energy prices, particularly crude oil and natural gas. A sustained move above $100 per barrel for oil, or a doubling of natural gas prices from current levels, would signal rising cost pressures throughout the food chain. Third, monitor weather patterns in major agricultural regions. The United States Midwest, the Black Sea region around Ukraine and Russia, South America's grain belt in Argentina and Brazil, Australia. These are the bread baskets. Drought or flooding in multiple regions simultaneously raises red flags. Fourth, watch for export restrictions. If even one or two major exporters impose restrictions during a tightening market, it could trigger cascading policy responses. Fifth, keep an eye on geopolitical tensions that could disrupt trade. Wars, sanctions, blockades, all can fragment markets quickly. The cycle also has financial market implications beyond grocery budgets. Food price spikes typically precede or accompany inflationary periods. Central banks respond to rising inflation by raising interest rates, which can trigger recessions. The 1973 and 1974 food crisis contributed to the stagflation of the late 1970s. The 2007 and 2008 spike preceded the global financial crisis. The 2022 spike forced central banks worldwide to raise rates aggressively, slowing economic growth. Understanding food price cycles helps predict monetary policy and recession risks. For investors, food price volatility creates opportunities and risks. Agricultural commodity futures offer ways to profit from or hedge against price swings. Agricultural equipment manufacturers, fertilizer companies, and seed producers see earnings affected by farmer profitability, which connects to crop prices. Food retailers face margin pressures during spikes, as they can't always pass through cost increases immediately. Restaurant chains that use commodity inputs see profit margins compress when grain and protein prices surge. Understanding the cycle helps position portfolios appropriately. Some researchers argue we should be grateful the cycle exists at all, because it represents the market self-correcting. High prices trigger increased production and reduced demand, which brings prices back down. Without this mechanism, prices might spiral permanently higher, or markets might collapse. The cycle, painful as it is, reflects the system working. This perspective offers limited comfort to families struggling to afford food during spikes, but it does highlight that the pattern includes both crises and recoveries, rather than permanent catastrophe. The question of whether the next crisis will be worse than previous ones depends on multiple factors. If climate change intensifies weather extremes significantly, production shocks could be larger. If geopolitical fragmentation increases, trade disruptions could be more severe. If financial speculation in commodity markets grows, price volatility could amplify. On the other hand, if agricultural technology advances sufficiently, if better governance reduces policy-driven amplification, if global cooperation improves, the next spike could be more muted. We're probably heading toward a future where both forces intensify, larger shocks but better systems to manage them. The net result remains uncertain. One aspect that gets insufficient attention is how food price volatility affects mental health and social cohesion. Constant uncertainty about whether you can afford to feed your family creates chronic stress. Communities where significant portions of households face food insecurity see increased crime, reduced educational achievement, and deteriorating health outcomes. The 8 to 10 year cycle means roughly every decade, societies experience these stresses intensely. This creates intergenerational trauma and political instability that persists beyond the immediate crisis. The pattern repeats. The machinery drives it forward. Weather variability depletes stockpiles. Energy shocks compound costs. Policy responses amplify spikes. High prices eventually trigger supply responses. Inventories rebuild. Prices calm down, and the cycle prepares to repeat. Understanding this rhythm doesn't necessarily prevent the next crisis, but it provides framework for anticipation and preparation. The 2022 spike is behind us. Prices have moderated, but the vulnerabilities remain. The next explosion is coming. Historical patterns suggest late this decade or early next decade. Climate trends suggest it could come sooner and hit harder. The cycle continues. If understanding patterns gives you an edge in navigating what's coming, if recognizing that food prices don't move randomly but follow predictable rhythms helps you prepare your household or your portfolio or your policy. Then the pattern matters. The grocery store where you stood in 2022 watching prices explode will see it happen again. The riots that erupted in distant countries during past crises will erupt again somewhere when the next spike hits. The political instability that food insecurity creates will destabilize governments again. This isn't prophecy, it's pattern recognition. The cycle is repeated 5 times in 50 years with mechanical consistency. Climate change and geopolitical volatility haven't stopped it. They've intensified it. The next time you're buying groceries and prices seem reasonable, remember that calm is temporary. The next time energy prices start climbing and weather reports show drought in wheat-growing regions, understand those are warning signs. The next time you hear about a country imposing export restrictions on grain, recognize that as a cascade beginning. The patterns are visible if you know how to see them. The question isn't whether another food price shock will hit. The question is when, how severe, and whether we'll be ready this time. History suggests we won't be. Each cycle catches populations and governments off guard even though the pattern repeats reliably. Memories fade quickly during calm years. Budget pressures push against maintaining expensive stockpiles. Political incentives favour short-term thinking over long-term preparedness, so the cycle perpetuates. Prices explode, people suffer, systems adjust, prices calm, vigilance fades, and vulnerabilities rebuild. 8 to 10 years. Again and again. The food price shock cycle. Now you know it exists. Now you can watch for its return. The pattern doesn't lie. The next crisis is already forming. The only questions are timing and magnitude. If you found value in understanding this cycle that affects every household but gets so little clear explanation, if seeing the machinery behind seemingly random price explosions helps you make better decisions for your family or business, then like and subscribe. Because they're not going to teach you in school that food prices follow predictable patterns driven by inventory dynamics, energy costs, weather shocks, and policy cascades. They're going to tell you each crisis is unique and unpredictable, but you know better now. You've seen the pattern. And patterns, once recognized, give you power that ignorance never could.